Are you really new to DeFi and you want to know how DeFi works and how you can make money with DeFi? So in this video, we're going to talk about how DEXes and AMMs work. Okay, DEXes are short for decentralized exchanges and AMMs are short for automated market makers. So in order to know how the market makers in DeFi are special when compared to centralized finance, or what you would find on centralized exchanges like Binance, Bybit, or Coinbase, or all the other huge exchanges right there that has an app on the phone that's usually called centralized exchanges. So those centralized exchanges actually needs market makers. So market makers on centralized exchanges, their job is to place both buy and sell orders on the order book, okay? And in order to provide continuous liquidity for a trading pair, for example, let's just say this is Solana, okay? Solana in the Solana market. So Alice wants to buy Solana at a price at $49, and Bob wants to buy Solana at a price of $51. So here is the illustration of order books on DEXes. So let's just say it was the same example as before. Alice wants to buy at the price of 49 and Bob's wants to sell at a price of 51. So it would probably look like this. And this is what you will usually see on centralized exchanges like Binance. So how do market makers actually profit? So they profit from the spread. They profit from the spread between the buy and the sell orders. If you see here, there's this price spread of $2 here. So for example, if they want to buy here, they input an order at a bid price for 49 and they also put ask price immediately at a price of 51, that will be a $2 profit for each cycle of trade. So it's a high frequency. They use computer algorithms and APIs to adjust to their quotes in real time based on market conditions. And they also manage quite advanced trading strategies, like they also manage inventory risk. So for example, if you bought too much Solana, you would be exposed to the risk of the price going down. So by rebalancing positions or using hedging strategies on the futures market or on the options market, they can actually eliminate this risk of holding the asset for too much. And yeah, market makers often receive trading fee rebates or incentives from exchanges or even token projects aiming to boost the liquidity. So the whole idea here is to let people buy and sell tokens with a huge amount of money, and yeah, they are paid to do that, and this is how they work. This is the mechanism behind market making on centralized exchanges. So let's just get straight into business. So introduction to Uniswap, the main use case of DEXes. So there are two main use case of DEXes. Here is quite confusing overview, but we'll get to it step by step. So there's two things you can do on a decentralized exchange, mainly on Uniswap for now. There are a lot of protocols that adapts Uniswap model into their own protocols. This is like a very fundamental review and a very fundamental lesson on how most DeFi actually works. So if you understand this, you would actually understand most of the protocols using the same concept, okay? Like AMMs. So in here, we have two in a DEX, which is the first one is a trader. So you swap your tokens. So for example, you want to buy Ethereum. Okay, you want to buy ETH, but you only have USDC. You can go to Uniswap and you swap USDC for Ethereum. The next one is what we're going to actually focus, because this is mainly how we're going to explain how this works and how is this revolutionary for us and how to make money from it, is the liquidity provider. So we provide the tokens, we deposit the tokens, usually it's 2 tokens, using a certain amount or a certain proportion, which we're going to talk about more later, in a pool for these traders to swap for. For example, right here, In a pool of Ethereum against USDC pool, liquidity providers can actually supply our tokens into this pool and earn trading swap fees from traders. So these traders that do swaps on Uniswap, they pay fees. For example, they pay a 0.03% fee. And these fees will actually go into the liquidity providers. So these liquidity providers will get money for providing liquidity into Uniswap. So they provide Ethereum, they provide USDC into the pool, and the traders will utilize the tokens in this pool to actually exchange for the token that they want. So it's a win-win solution for the providers, as they will get the fees paid by the traders, and the traders will get the tokens that they want. Okay, so moving on, in this first scenario, there's a trader which wants to swap ETH to USDC. So they have ETH, they want to sell their ETH to USDC. So this will increase the liquidity of Ethereum in the pool, and it will decrease the amount of USDC in the pool. So we're going to visualize this. So Ethereum is this circle getting larger, which represents the increasing liquidity of Ethereum and the decreasing amount of USDC in the pool. Why is that? Because this trader swaps Ethereum to USDC, so they will put more Ethereum into the liquidity pool and get USDC in return. After this, they will pay a trading fee of, for example, 0.5%, and this will be paid to the liquidity providers that provide these tokens in the liquidity pool. Okay? And what if you want to buy Ethereum in the same pool? Okay, so this scenario too, this trader swaps USDC to Ethereum. So this would increase the liquidity of USDC, and this will decrease the amount of ETH in the pool. The visualization, the circle of liquidity pool, of liquidity of USDC is increasing here. You see the circle is getting larger, and the liquidity of Ethereum on the liquidity pool decreases because this trader will get Ethereum tokens, right? Because they want to buy Ethereum and they're selling their USDC. That's the simple way to say that. So they will put the USDC here in the liquidity pool and they will get Ethereum. They will get Ethereum here. And that's how it works. And again, they have to pay fees, and the fees will be paid to the liquidity providers. This is the liquidity. And that's how it works. So this is the before and after, to make this just clear. So that's a very simple overview, and I hope you're ready for the next part, because this is a very important concept. It's called the automated market maker pricing concept. So how is the tokens on DeFi, like the prices of the tokens on DeFi is determined. So it's determined by this equation. It's the supply of the token X multiplied by the supply of token Y equals a K, a constant number. And if we derive this equation, it will become like this. This is very complicated. This is only for the concept, so please hang on there. Yeah, I'm going to give you a scenario on why this automated market maker or pricing concept is so important to understand. Okay, for this scenario, there is Bob. Okay, Bob wants to swap 1,000 USDC to ETH. So here you will have the liquidity pool here. So assume that ETH's price right now is 4,000. Okay, and using the mathematical equation that we derive from the previous slide, so we put in all the numbers into the equation here. This is the amount of liquidity for token X, which is token X is here is USDC, and the change of token X is this one, 1,000 multiplied. This number will be divided by 1, which is the amount of ETH, and 1,000 is the change of supply here. So in the end, this equation will be the equation here will be the result, and from this equation you will get 0.2. You will get 0.2 ETH, not 0.25. This is using the pricing concept equation, okay? And so there would be 5,000 USDC after the swap happens, and there will be 0.8 ETH because Bob gets 0.2 in this trade, and this will impact ETH's price to 6,250. Okay, that's a very huge price impact that happened. Why? Because the liquidity here is super small. Okay, there's only 4,000 USDC, and he wants to swap with an amount of the amount on the liquidity pool here. So the price impact would be really huge on this liquidity pool. Okay, how do we get 6,250? It's very simple. It's 5,000 divided by 0.8. Okay, and you'll get 6,250. All right. In the high liquidity scenario, what usually happens right now in Uniswap, they really have like really high liquidity on Uniswap right now. And using the same equation here, token X is USDC and token Y is ETH, he wants to swap the same amount, okay? So let's just say Bob only has 1,000 USDC and he wants to buy ETH. Will he get the same amount, 0.25? So liquidity pool here is the same composition, okay? It's the same amount. It's 40 million USDC and 10,000 ETH. Okay, so it's a 4-digit zero increase from the previous liquidity pool that we use as an example. So again, ETH price here is 4,000, and gonna use the same mathematical equation here. Okay, and after adding these numbers, it's quite confusing. You'll get 0.24999 ETH. Okay, so you'll actually get more than the previous 0.2 in a lower liquidity pool. Okay, so the price impact for this swap in a high liquidity pool would be really small right here. It's only I don't know, it's less than 1%. And the change you can see right here, there is an added 1,000 USDC on the liquidity pool, and the price impact will be smaller. So this is why a high liquidity in a liquidity pool is very important in DeFi, because that would actually impact the price of the token itself as well. So yeah, that's how automated market maker works. Okay, so let's say there is another scenario. There is this trader, Alice, and Alice has more money, more than Bob, and she has 4,000 USDC and she wants to buy ETH again. Will she, in the same liquidity pool here, in a very low liquidity pool, here, there's only 4,000 USDC and 1 ETH, and she is trying to drain all of the liquidity down. Will that happen? So again, ETH price here is 4,000, and using the mathematical equation, 4,000 USDC, change here, put it in here, and then 1 ETH on this one, and 4,000 on this one, you will get only 0.5. It's not 1, because of this A pricing concept equation. Okay, it's a quite powerful equation, and after the swap happened, there will be an added liquidity of 4,000 USDC, so there will be 8,000 USDC and only 0.5 ETH. And if you can see here, the price impact for ETH will be really huge. Okay, it will go soar up 4x immediately after the swap. Why? Because the supply of ETH in this liquidity pool is drained to a certain amount. Okay, she's trying to pump up the price, buy as much ETH, but it's not work. It wouldn't work like that because of this A pricing concept. The price went up. It went up, but it's not on her expectation of draining the entire liquidity pool. Okay, so the only way to drain a liquidity pool is to actually take out the liquidity from the liquidity pool. It's that simple. You can't buy, you can swap the tokens until you drain all the liquidity pool here. Okay, that's impossible. Okay, due to this equation. Okay, so Uniswap v3 introduced a very revolutionary concept. It's called concentrated liquidity. But before we go into this concept of concentrated liquidity, we need to know what is Uniswap v2. Okay, so Uniswap v2 introduces a full range liquidity. Okay, so this is especially for the liquidity providers. This concept is for them. Okay, it's for us. If we want to provide liquidity, we need to understand this concept. So this is a very crucial concept, especially when we want to liquidity provide, because liquidity provide is one of the main ways where we gain swapping fees, trading fees, and from those fees we would gain like APRs, we would gain money, we would be incentivized with providing liquidity in the pool. So in this chart right here, this axis is for token X supply and this axis is token Y supply. And what does this curve actually represent? This curve represents the price of the liquidity pool it can trade on. As you may remember, X times Y equals K. So this K is a constant number and it wouldn't reach zero. So this curve and this line and the axis right here wouldn't touch. In any scenarios, it wouldn't touch. On Uniswap V, you previously only provide liquidity on a full range, meaning when you provide ETH or you provide USDC, it would be distributed amongst this curve. It will be equally distributed amongst this curve. This curve would range from 0 to infinity. This is the price the liquidity pool or the asset price will trade on. It could go like 100k, I don't know. So yeah, that's how it works. So why is this model inefficient? Because most assets only trade on certain prices. For example, you got ETH right now trading 4,000 US dollars. When compared to USDC, it's only trading between usually 3,500 to 4,200 maybe. And to visualize that, they will actually only trade amongst this concentrated curve. If you actually provide liquidity from 0 to infinity, you would actually provide liquidity amongst the entire curve, and that will result in lower utilization of the tokens that you lend into this liquidity pool, because the price only trades around here, but you deposit your assets and it's applied amongst the curve outside this trading range. That is where Uniswap V concentrated liquidity comes into hand. So Uniswap V actually allows you to put concentrated liquidity. So liquidity providers can choose a price range to put their token liquidity at. Here is the visualization. They can choose the price range on where to provide liquidity. Why is this significant? The assets that they deployed into the liquidity pool will have higher utilization, and higher utilization would result in higher APY. Indirectly, this mechanism would also help with risk management. So with the same amount of money in Uniswap V2, like for example, you need to deposit like 1 million USD to get like a 20% for example. With a concentrated liquidity pool concept here on V3, you will only need like maybe 300k US dollars to get the same amount of money. Okay? To get the same amount of money. Since the APY would be like maybe higher, like 60%, maybe. We'll have to see in a real example. But yeah, that's how it works, because this 300k would be more utilized in the liquidity pool, because the range only trades across this price. It doesn't trade here, it doesn't trade here, and it only trades upon this price range. So the tokens that the liquidity providers provided will be higher utilized.